So what you need to focus on is your trading result for at least 12 consecutive months. And before you even thinking about your CTA registration, what you need to understand is the sweet spot for return. So if you are targeting 50% or 100% return per year, they're going to pass on you because they understand, the institutional money understand that risk and reward go hand in hand. So when your return is way too high, that means you're too risky and they will pass on you. Now, if your return is less than 5%, that means you're too low, too safe, and they will also pass on you. So the sweet spot for your trading result should be anywhere from 14% to 22%. And that's a good target that you should be looking at. So this is just starting out on the trading result. The second thing that they look at is the number of trades for the 12 consecutive trading months. Now, have you performed more than 2,000 trades? Are you high frequency? Are you scalping? What's your average hold time? What's your slippage? Is it repeatable? Because if you are doing scalping 2, 3, 4 pips per trade, it's not scalable. Your trading could be fine for $20,000 account, but when you're trading 100,000 or $1 million, it's not scalable, so hence they would pass on it. So what they want to see is a trading methodology that you can scale it. Now, let's say if you are one of these people that not make too many trades and you only have 50 trades, actually that would work against you too because the number is too low because they can't tell whether or not you have an edge and your trading system really works or you're actually just lucky. So you do need a larger sample, of trade for them to determine whether or not you really do have an edge in the market. In terms of risk management, it's also very, very important. Actually, I would say that the drawdown is more important than the actual return. Because how they look at your trading record is that if you have greater than 50% drawdown, that means it's too high, too risky, and it will also pass on you. Now, if your drawdown is less than 5%, it's too low. That means it's too good to be true. Because you may claim that you have 5% drawdown, but chances are you have some hidden risk, as in you don't use a stop loss. You basically have a floating loss and you only cash out when the markets kind of return towards your favor. So basically they will look at these things. Now, a sweet spot for drawdown is anywhere from 15% to 20%, or maybe 25%, which is considered reasonable. You have to realize when you're managing $10 million, 20% drawdown is $2 million. That's a lot of money. Whereas if you're trading with $10,000 account, 20% drawdown is only $2,000. It's no big deal. But when you want to scale up and manage serious money, drawdown is very important because, yes, you can risk a $2,000 drawdown, but for institutional money, 20% drawdown of $10 million is $2 million loss. That's really, really serious money. In terms of winning percentage, they also look at your winning percentage in terms, if your winning percentage is greater than 90%, guess what? They will pass on you because they know that it's too good to be true and that chances are you are holding on to a losing trade. So your trade could be floating and it could, your balance looks good, but your equity, you could be holding a trade that is 300-400 pips against you, and they will pass on you. The other thing that they talk about is your winning percentage. If your winning percentage is really low, like less than 25%, they will also pass on you. What's critical in terms of institutional money is, do you trade with a stop loss? Do you use martingale betting system? When and how do you exit a loss? Because to serious investor and large amount of money, they need to understand when you get out of a bad trade. Because as we all know, we do get bad trade, and it's how we handle these trades that able to generate profit for us. So it's very important that, you have a trading plan, and that the losses are managed in such a way that, you're not going to experience a 99% winning trade, but one losing trade could wipe out 2 years of good trading records. So it's more or less like gambling. It's not really investment or trading.